Good morning. It's May 28th, 2020, noon, and we are pleased to have you join us today for the capital management look at small cap opportunities. We have a long track record with small caps. It goes back over a 10-year track record, and we're really excited about what we're seeing in the market today. As the economy exits the recession and we see access to credit and confidence improve, it's our experience that small cap companies will tend to benefit the most and lead the stock market out of recessions. For small cap stocks, the sensitivity is comparatively greater than for large cap stocks, given they are more domestically oriented and less diversified with regard to their revenue streams than more internationally and revenue diverse larger cap. As a result, this will be reflected in wider swings in revenue and earnings growth for small cap stocks, but also an opportunity, we feel. With that, I'll pass this on to Tim and Mark, who will be taking over here. And I just want to remind you all, too, that we will be doing a Q&A at the end. And just as a reminder, you can actually type in your questions for us here under the question box there. But with that, I'll pass it on to Tim.
Well, despite this being the fastest bear market of our lifetimes in the history of the New York Stock Exchange, while the economy was growing in January and February, it entered recession in March, and we've had record stimulus from the federal government and from the Federal Reserve. It's record speed, record magnitude, and here we are in May, and many states are reopening for business. So we are set to grow off a very low base. The economy is. So it started in March, and we're not even done with May yet. This has been pretty fast. So volatility and uncertainty accentuated the sell-off. As uncertainty fades, we have this record stimulus and many opportunities. So we show a page full of opportunities that we think are intact and will greatly benefit our clients. And today we're focused on the small cap opportunity. We have an overall valuation discipline. Your return on investments highly depends on what you pay for them. And small caps have been ignored over most of the last 10 years, and greatly so over the last 3 years. Yeah, as Brad said, they tend to do rather well early in economic cycles. And long-term, small caps have outperformed large caps over the last 50 and 100 years. So this is quite an opportunity. And the magnitude of recent underperformance is quite large. So when we look at the last 3 years, large caps, represented here by the S&P 500, have outperformed small caps by around 28%. So that is extremely large. And again, usually small caps outperform large caps over long periods of time. So even though some people say the market is expensive, there are plenty of areas within the market that are not expensive, that represent great opportunities. Another example of disparities in the market is that growth stocks have outperformed value stocks by a great deal over the last 10 years, much of that in the last 3 years. So we see over more than 50% outperformance of growth over value the last 3 years. This again tends to change early in an economic cycle. So if we have stronger economic growth, value stocks can outperform growth stocks. And over the last 50 and 100 years, value does outperform growth. So again, this is an example of a great entry point into the category. And past that, we had stock selection. So there's some very, very attractive investments out there. And now I'm going to turn it over to Mark to show this more graphically.
Thanks, Tim. This chart is not the market, so don't be confused on what it is. What it is a representation of growth versus value. So it is growth divided by value, so that when the line is going up, it means that growth is doing better than value. And when the line is going down, it means that value is doing better than growth. So I think the very interesting point to make is that, number one, as Tim mentioned, it's been roughly a decade where growth has been outperforming value since we exited the financial crisis in 2009. The value stocks tend to have a lot of energy in financials, and as everyone remembers, financials were the hardest hit area in 2009, so that wasn't particularly shocking that growth led value that time. I think the interesting thing is on the right side of the chart, we can see that recently the trend has become extreme, and extreme to the level that we haven't seen ever, and extreme to a level that was higher than we saw in the tech bubble of 98, 99, 2000. So I think we all remember that as an extreme moment where there were certain stocks that were favored over others. And if you had .com at the end of your name, you had a huge valuation. And if you didn't, you were forgotten. And in retrospect, it seemed obvious that had to change and was silly and was a bubble. But remember, at the time, it was thought that this is a new economy, this is a new way of business, those old companies aren't going to be able to survive. So I do think it's interesting that throughout the course of the coronavirus, we've kind of seen things that rhyme, so to speak, with 1999, where growth companies have certainly garnered most investor attention and value's been left in the dust. And the thought is that these companies are well positioned to withstand some of the new trends and might benefit from some of the new trends due to the virus, and the other companies will not. So of course, we don't know how long this trend can last. We don't know how extreme it will get, but it does seem like we have reached a level where certainly we're a lot closer to the end of the trend of growth outperforming value than we are at the beginning. And I would expect value to catch up a little bit versus growth in the near future as things settle down a little bit and we begin to exit the recession that we're in from the coronavirus. So I think it's interesting to look back and say this is a high that we haven't ever seen before, and just the extremity of what's going on. And then if we look at the next chart, we have another focus, and this is more mid and small cap versus large caps. And there's a mega cap technology concentration in the S&P 500 that we really have never seen before. So 5 stocks, which are all mega cap tech. We view them as tech. They might be in different sectors from other services, but Microsoft, Apple, Amazon, Google, Facebook represent approximately 22% of the S&P 500, which is $26 trillion. 3 of those stocks have over $1 trillion market cap. So Microsoft and Apple are right at 1.38 trillion. Amazon's at 1.2 trillion. Google is at 969 billion, and Facebook is a tiny little company at only $652 billion. So that's a massive concentration from the S&P 500 large cap index in 5 stocks that are all in generally the same area. And as you can see, the entire S&P 600, which is a small cap index, is roughly $700 billion. So Microsoft, Apple, Amazon, and Google are all larger in one company than the entire small cap index. Facebook trails, but not by much. So Facebook at 652 billion. If it goes up 10%, it'll be there. So there's a tremendous opportunity, and you can think of the size of the S&P 500 at 26 trillion and the S&P 600 at only 0.7. If just a little bit of money goes out of Microsoft, Apple, Amazon, and Google and moves its way into the S&P 600, into these small cap companies, there could be a tremendous difference in performance. So of course, the small cap companies aren't nearly as liquid And so a small amount of dollars from the S&P is a massive amount of dollars for the small cap index, the S&P 600. So this has kind of become out of whack. And as I mentioned before, it's hard to predict when it will reverse and when it will go back to kind of historical norms. But we do know that it's currently out of balance, and so we would expect that over the next 3 to 5 years, certainly there's going to be more opportunities in those stocks that have been unloved and ignored, rather than those that are the high flyers that everyone knows about and that make up over a fifth of the index and that are household names. So it's the performance difference has been powerful up till now, as Tim pointed out on a previous slide. It's been a massive performance difference, and we think that could reverse, and we could see those things even out over a long period of time. So I'll turn it back over to Tim so he can comment on the incredibly quick and massive actions undertaken by the Federal Reserve.
So on this page, we see the Federal Reserve's balance sheet, the total balance sheet, total assets in red. And before 2008, so just 12 years ago, through the entire history of the Federal Reserve, their balance sheet was never 1 trillion. It was always below 1 trillion in size. That was just 12 years ago and through its whole history. And in the last 2.5 months, they've increased the size of their balance sheet by around 3 trillion. And they're still printing money. They're still buying lots and lots of bonds. They are also backing loans that banks are making that banks wouldn't otherwise make without the Federal Reserve backing them. And on top of that, the federal government's created a 4 stimulus package is in record speed. The 4 that have become law total around 3 trillion, and they're working on more. If we just take the stimulus that we know about so far, and what we think the Federal Reserve's printed in recent weeks, which recent weeks are not on this graph yet, the total stimulus might be around 8 trillion, and in the end, it might be greater than that. Well, this 8 trillion that's moving out of the federal government and Federal Reserve at record speed has never been seen before, this amount of money hitting the system. If it changes hands 5 times in the next year, it has the economic effect of 5 times 8 trillion. So it has the business or economic effect of 40 trillion. And at its peak, the U.S. economy was only 21 trillion. So this scale is not only unprecedented in magnitude and speed, but it dwarfs everything we've seen before, and makes it so we don't really question whether there will be a recovery. The virus might come back, the vaccines might take a little bit longer, but the recovery is coming. The worry is there's too much money in the system next year chasing the same amount of goods and services. And one of these items that could be chased are attractively priced stocks. And if you send some of this money into the small caps, the S&P 600, it doesn't take much to move those stocks. So with just the value of Microsoft, you can buy those 600 companies, 100% of them and more. So as money moves into the stock market, some people will pay attention to valuation, and we think they will move toward value stocks and small and mid-cap stocks. And there are other themes that we think they will move toward, and you can have certainly overlap in opportunities. But this graph certainly shows that the Federal Reserve will do whatever it takes to reopen this economy. And we have already seen states start to move in that direction. The sell-off has created a great opportunity for us to add to our highest conviction holdings and add new oversold growth opportunities to the portfolio. Companies that we wanted to buy but were too expensive now we've been able to buy those. And we look forward to taking advantage of many growth themes that will play out in upcoming years. And with that, I'd like to turn it over to Brad for questions. And Brad, I can't hear you.
Sorry about that. At this point, we will do questions. So at this point, go under your question toggle there on your screen. You can type out a question for us, and we will address them as they come in. And I just want to also say that we will be posting this webcast up on our website here as well. So we'll give everyone an opportunity, as well as the deck will be up there as well. With that, first question is, so as you're highlighting small caps as a place to invest your kind of in an inflection point, is there specific verticals you would be looking at, industries per se, that you think are more attractive than others?
So there are several attractive opportunities. Healthcare and medical advancements, we see many companies have been ignored there, as healthcare companies have had bad PR in recent years. Now they're getting good PR, but there's some great advancements in medical care and drugs, and some of those stocks will greatly benefit from those advancements. With 5G or telecom, the phone companies have seen their systems be stretched in recent months with the move of business to home and telecommuting. At the same time, 5G or the next wave of technologies coming out with phones and infrastructure. You have to build the infrastructure first. Now that the Sprint merger has been completed, that company is spending money on 5G, which has made it so that Verizon and AT&T speed up their deployment. And so there's lots of money to be made there, including from patent holders and distributors. There's other logistics and distribution opportunities, which not only include the delivery to the home, now that more people are working from home, but also the returns, which is quite a big business. Some people order several items intending to send some back after they see what they're like. And we're taking advantage of that. The other new technologies are in batteries. So the components of those batteries, including lithium, and the battery makers, and then the deployment of those batteries, which will include the 5G placement of devices. And then there's a lot in the consumer goods area. Just to mention one area of part of that in the consumer staples, the foods. There's some companies that, in order to exceptionally benefit from the move to at-home eating. So some companies didn't have much exposure to restaurants or cafeterias. They have the majority of their exposure to the center of the grocery store. So when people phone for delivery of groceries or go into the grocery store now and replace those meals that they were eating out or eating at work, a few companies are greatly benefiting from that. And so we're very excited about some of those, and have reasons to believe why they will continue to grow in the future, even as people return to the office.
Great. Thank you, Tim. Next question. How will the makeup of your portfolio offerings be affected by emphasis on small caps as to the ration of small, mid, large cap holdings? So how have we adjusted our holdings here in light of our opportunities we're seeing?
Well, we're all cap managers. Most of our portfolios have always had large, mid, and small stocks. And with our valuation discipline, we found in recent months and in recent years, more value stocks and more small and mid-cap stocks were making it through our system and passing our disciplines. So exposure there has been increasing, and our research there has certainly been increasing and very focused on those opportunities. And the recent sell-off has made it so that more of those opportunities are even more attractive. And so we have been putting money to work in those areas, and an all-cap portfolio might see itself with 1/3 large caps, 1/3 mid caps, and 1/3 small caps, approximately. And that is very different than how you see the S&P 500 index, which is 100% large caps. So the S&P 500 index won't take advantage of this as well. As the more money had gone into the expensive stocks, making them more expensive, they've become a larger and larger part of the S&P 500. So when value does start to outperform growth, and value is just a much smaller component of the S&P 500 now than it was 10 years ago. So the index won't see much benefit from a resurgence in small cap or value, but we are very well positioned for that.
Next question. What is your read on the impact of the coming election, and is COVID-19 a bigger worry than the election? And maybe we'll have Mark address this starting, and then Tim, you can address it as well.
I think certainly in the short term, COVID-19 is a bigger worry than the election. That will have a much bigger impact on the economy and profits of our companies than the election. Politics and elections, they happen every 2 years, presidential ones every 4 years. And I think a lot of people tend to put more emphasis on those and the impact of the market than they actually have. There's been a lot of studies done over, which makeup of Congress and president and which party is best, but a lot of times there's idiosyncratic factors that happen to make things kind of different than what you might expect. So I think certainly if we had not had the virus, I think the upcoming election would probably be the A block of the news most nights, and we'd be dealing with a lot of politics and political maneuvering there. With the virus, obviously that's the A block, and there is always a political tint to what you read and how things have been handled and how things are going and how things could have been better or could have been worse. But I do think as we get through and the impact of the virus lessens throughout the summer and the election draws closer, my guess is that coverage will shift to less virus and more politics. The impact is really difficult to predict. I think all you have to do is look back at the last presidential election where you saw predictions of dire consequences for the market if there was the outcome, which was the one we got, but also the one that was viewed as the less likely outcome. So it's really hard to say what will happen. I will say that the two candidates, obviously, if the incumbent is reelected, there's not going to be much change in things. And if the challenger is elected, we do have the challenger that is, I think, probably the best for the stock market and businesses. So we did not get a very, very far left socialist candidate nominated. So that, I think, is a positive for the market overall. So it's really hard to read what that will do. But I will say that politics, politicians have an impact on the economy, but they probably don't have as much as they'd like to take credit for or take blame for as what's going to be the impact of everyone going back to work, getting back out to eat, and participating in the economy. So I think the COVID-19 impact is going to dwarf the election impact, at least in the next, let's call it 18 months. And then we'll see what policies are enacted that may or not be different from what we have now to to see what the ultimate impact is. Tim, if you have anything else to add.
The market hates uncertainty, so the depth of uncertainty was in March, where we did not know much about COVID, but it closed the economy. Now we know how to put on masks, and we know social distancing and have experience. So if there's a return of the virus, there's less uncertainty than there was in March. So I think in March, we hit the lows there. With elections, again, the market doesn't like uncertainty. More uncertainty occurs when you don't know who the candidates are. But once the primary season has winded down and you know who the candidates are, the market tends to do better because there's less uncertainty. And as we get closer to the election, people tend to believe they know who will get elected. So again, there's more certainty. And after the election, people tend to initially like who they voted for. So again, there's more certainty. So it's quite possible with less uncertainty, both on the end of the virus and politics, combined with this massive stimulus from both the federal government and the Federal Reserve, that the market, while remaining volatile, could continue to rise for the rest of the year and into next year.
Thank you. Another question here is, how do you anticipate dividends will hold up for small caps, and what has been the experience in the last 4 years?
It's very company specific, and many small cap companies don't have earnings. Even more don't generate cash. And so when we're talking about companies, small companies generating cash and earnings and paying dividends, it's a small subset of the small cap universe, a very healthy subset, and we believe that is the place where you want to be. There are different reasons for dividend cuts if you think there's high uncertainty, as in March, and you want to make sure that your business can handle any situation. You might cut or eliminate your dividend. We don't like to see that kind of move. But as the economy reopens, many of those companies would reinitiate their dividends. With other small firms, they are less cyclical and more stable, even though they're small. And you can readily count on those dividends, and many companies are increasing their dividends annually, and we expect that to continue. So just because the company is small doesn't mean whether they'll cut or increase their dividend. It's more specific on the industry, the type of company, and management. But we think you'll see better headlines with dividends in the months ahead.
Thank you. And with that, this will conclude our broadcast here for today. We really appreciate everyone in attendance. And if you have any follow-up questions, please don't hesitate to reach out to Mark, Tim, or myself. We're always here to help out, and we will be in touch with future broadcasts here in the near term. Thank you.